Should you pay off your mortgage before you retire? This is a very important question to ask yourself as you are getting closer to retirement. Maybe you're, less than 10 years away and you've been diligently making your mortgage payments, you've been diligently saving, and then all of a sudden you ask yourself, should I just continue to make the minimum payment or should I try to get rid of this mortgage before I actually no longer am earning this paycheck? So in this video, we're going to walk through a case study that shows a comparison of continuing to pay the minimum on the mortgage and compare that to deciding to forego some additional savings in exchange for getting rid of that mortgage before retirement. So first off, there are a lot of considerations that should be going into the decision to add more on the mortgage or compared to saving and investing more. So when you're working with an advisor, make sure you brainstorm these things together. And it's not just a simple yes, do this or yes, do that. So here are a couple things that you should take into consideration. Number one, your current plan trajectory. Based on your current mortgage payment strategy, how do things look? How does your financial plan look? Number two, are there significant tax benefits to carrying the mortgage now and significant tax benefits in retirement? I personally think that the tax benefits of homeownership are oversold, as in there are certainly tax benefits, most definitely. But are they so dramatic that it's going to change the trajectory of your financial plan, whether you have a mortgage or not? Probably not, but it is absolutely a consideration. Another important consideration is what's the risk-free rate versus your mortgage rate. And what I mean by risk-free rate is if you just kept that cash in savings as opposed to adding it to your mortgage, what are you earning on that cash as an interest rate versus your mortgage rate? And oftentimes your mortgage rate, except for those that refinanced around 2020, 2021, your mortgage rate is oftentimes higher than your risk-free rate. And it makes the decision a little bit easier to add more to the mortgage versus saving, but not necessarily always to be the case. But it is an important consideration. There's also the psychological aspect of it, which it may be that you have a 2% mortgage rate and your risk-free rate is 4%, but it may not necessarily matter because the psychological impact is so great for some people around not having a mortgage that it trumps any sort of rate of return that they can earn versus continuing to just pay the minimum mortgage on a 2% minimum mortgage payment on a 2% mortgage. Another consideration is your risk profile. Maybe you should invest that money. If you have the appropriate appetite for risk or understanding of risk, you may end up being better off investing that money as opposed to paying down on the mortgage. So one more is, what is the plan for the excess cash? Are you going to add it to your savings account? Are you going to invest the money? Are you going to increase your 401k contribution? What's the plan? So having a plan for the excess cash. These are all important considerations when deciding whether or not to pay more on your mortgage versus investing the money. Let's jump into Theo and Cassie Steno, who we've looked at in other videos. So Theo and Cassie are somewhere about, I would say, about 7 years away from retirement. And they're done paying for college for their kids, and they've got some excess cash flow. And they've come to their advisor and they want to talk through what they should do with the excess cash flow. Should they invest the money or should they add more to their mortgage to try to eliminate that mortgage before retirement? So what we're looking at here is on the x-axis is time, so year to year, all the way through retirement to death. And then on the y-axis is approximate portfolio value at the end of each year. They're on a pretty good trajectory, but they still have some concerns in the event of long-term care, or they have discussed the idea of maybe giving some gifts to their kids during their lifetime as opposed to at death. And so there's other considerations that are going into their financial plan that have led to them to this path of, hey, we are considering getting rid of our mortgage before we retire. And so what we would want to do is look at some numbers and determine, okay, well, if we pay extra on the mortgage, how does that positively impact your financial plan? Well, it has a significant positive impact. And why is that? Well, it's because they no longer have a mortgage in retirement. And obviously that's going to translate to lower expenses. And so less expense during retirement means less portfolio withdrawals, and therefore they end up with a higher portfolio value at the end because of the fact that they're taking less out. So there is a positive net delta of $1.9 million in the event that they decide to pay off their mortgage before they retire. Well, what if they, instead of doing that, invested the free cash flow? So we just assume that they continue to pay the minimum on the mortgage payment, and instead that free cash flow that they have between now and when they retire, they invest that into their investment account, their trust investment account. So remember, on the previous case, it was approximate value gain was 1.9 million. If instead they decided to continue to carry the mortgage and invest that money, their portfolio gain would be approximately 2.4, 2.5 million. So obviously there's a positive delta between their mortgage rate and investing. And that's because we've determined that their mortgage rate is low enough that the investment return projected is going to be higher. And therefore, there's obviously a positive benefit to continuing to invest. It may not necessarily matter. And it may be that even if it's a 2% mortgage, again, like I had said earlier, some people just want to not have that mortgage in retirement, and that's their primary goal. And so therefore, no matter what the numbers say, they just want to get rid of that mortgage and get it paid off before they retire. So in Theo and Cassie's case, they're still kind of on the fence about this idea of continuing to pay the minimum, and maybe they're still on the fence about investing because they're concerned about financial markets. So the other part of this equation is, well, okay, we understand that there are some positive benefits to investing the money, but there's other factors that we want to take into consideration with this. Maybe it's long-term care planning, or maybe it's gifting to the kids. So maybe Theo and Cassie, they don't have long-term care insurance. So what if there was a case where Theo needed some additional care towards the end of his life? And how is that going to negatively impact the plan? And so what I've done here is I've added a scenario where Theo needed long-term care in the last 4 years of his life. And we added that layer of stress test on top of the additional savings. And as you can see, by saving, but still in having that long-term care event, this is still a better outcome than their base plan. If they did not save that money and they just continued they increased their lifestyle and they did have that long-term care event, you can see that they're starting to get into a scenario where they would possibly have to sell their house. But if they were to invest that free cash flow, they would be able to self-fund this particular long-term care event. So let's look at it, how it compares to the extra mortgage payments. So same exact scenario. If they were to make extra mortgage payments and they did have that long-term care event, the value lost is $884,000 compared to the value lost on the free cash flow of only $537,000. So even in a case like that, they were still a little bit better off by making minimum mortgage payments and investing that free cash flow. And then we can add things like gifts to the children to add that as an additional layer to see how that stress tests the plan. But the whole point of this is that looking at the scenario of paying off a mortgage before you retire should not be looked at in a vacuum. It needs to be looked at in the context of your entire financial plan and looking at these other contingencies. And furthermore, just because you may be able to earn more by investing doesn't necessarily mean you should continue to pay the minimum on your mortgage, because for some people, paying that mortgage payment just creates such a level of fear and anxiety as a part of their financial plan that investing the money just does not make sense for that particular person. So if you have questions about your investment strategy or your mortgage payment strategy as you get closer to retirement, please let us know and reach out, and we would be glad to have a conversation with you and see if there's a way that we can help you.